It's 1990, and the CEO of Salomon Brothers is calling down to the offices of Phibro, a commodity trading subsidiary inside of the bank. He wants to know what's going on. Normally, the unit doesn't have a whole lot of expenses since they're really just buying and selling numbers on a screen, but suddenly they are burning through hundreds of millions of dollars. Andrew Hall, the leader of Phibro, assures him there's nothing to worry about. They just made a killing pioneering a technique where a trading company rents oil tankers to actually receive the oil from the contracts they're trading, sells future contracts against that inventory, and locks in guaranteed profits. It was the type of insight, many years later, that earned Hall a performance bonus so large that the United States government tried to take it away from him. The trade that got Andrew Hall into trouble had to do with China. See, he looked at that country like anyone else and saw a lot of people. More than 1 billion of them, in fact. And then he looked at the Chinese economy and realized something. Hundreds of millions of Chinese people who had never been able to afford a car were going to be able to buy one. And they were going to live in houses that ran air conditioners. And they were going to have the money to spend on other frivolous things, all of which were either made from oil or ran on oil. In short, the demand for oil was about to increase drastically. At the same time, Hall recognized that the relatively low oil prices that had existed in the early 2000s had led to a lack of investment in the industry. People weren't bothering to explore and drill wells like they used to. Hall imagined a scenario where these two things would collide. China demand would surge, while the supply could not be increased fast enough to satisfy it. The result would be a spike in prices. Now, I imagine this insight wasn't entirely novel, but what Hall then did with this information was, he purchased oil futures contracts and options that would only pay off if the price of oil exceeded $100 a barrel, something it had never done before. Since this was viewed as incredibly unlikely, he would make a killing if he was right. Otherwise, the options would expire worthless. Then 2008 happened. Oil prices went nearly vertical and flew way past 100, peaking at an all-time and inflation-adjusted even high of $147 per barrel. You might remember seeing gas prices like these, or heard about a little car company called Tesla that released a car that could run on electricity instead. As a result, Phibro had an incredible year, and thanks to that incredible year, Andrew Hall was due a bonus of $100 million. If you'll remember though, 2008 was not an incredible year for most people or most businesses, and this is where Hall had a problem. Remember, Phibro was a part of Citigroup, one of the most badly damaged companies in the country during the recession. They survived, but only by the saving grace of a government bailout. In fact, they were part of a group of 7 companies that were deemed to have received exceptional levels of assistance, the others being AIG, Bank of America, General Motors, Chrysler, GMAC, and Chrysler Financial. This was bad for Hall because there were strings attached to that bailout money, one of which was that President Obama appointed Kenneth Feinberg to a position informally referred to as Pay-Czar, and as part of this role, he would oversee the salaries of all of the top earners at those 7 organizations. The intent behind this was sound. The struggling taxpayers who were shouldering the cost of the bailout would justifiably be irate to see their hard-earned dollars going to the same Wall Street elites who crashed the economy in the first place. Of course, Hall, in his energy trading division, had nothing to do with the implosion of the economy. He'd initiated his trades 5 years ago, and his performance-based bonus was part of a contract signed before any Pay-Czar even existed. But $100 million was still a grotesque amount, and no one was going to feel sorry for him if it was reduced. It was a situation that would never have had any winners. If Citigroup didn't stand up for Hall, obviously he walks, and then they lose the most important employee in one of the only profitable businesses they have. He probably can take much of his team with him too. Citi suffers, and as a result, their shareholders suffer. If Citigroup does stand up for Hall, it's a public relations nightmare. People could then decide they hate Citigroup and close their accounts, and he could still leave anyways if they lost their case against the government. So it's at least equally bad, might even be a worse outcome. From the government's perspective, they're going after someone whose pay was performance-based. It's basically they're saying, you were too good at your job, so you're going to be punished. Furthermore, they are bailing out these companies with the intention of being paid back. So if they tell all of them that they're not allowed to pay their best employees what they're actually worth, then competitors like Goldman Sachs, Morgan Stanley can just snap up those people and put Citibank out of business because they're basically then limited to hiring leftovers for any of their open position. If that happens, then the government has guaranteed a total loss of their bailout investment. To try and sell their position to the public, the government added a wrinkle to their argument that was pretty clever. They said they weren't really punishing Hall for performance. They were punishing him because the contract he had signed encouraged excessive risk-taking. And even though he didn't bring the economy down, it was exactly those types of incentives that drove people like him to crash the global economy. Now, there is a solution here, and it lets everyone save face. Can you see it? Someone at Citigroup did. If you thought that maybe instead Hall could receive his compensation via equity instead of cash, it's a good guess, and actually Hall proposed that to try to get around the situation, but Feinberg wasn't having it. Instead, here's what happened. Citigroup realized that Phibro without Andrew Hall wasn't worth very much, and that they couldn't have Phibro with Andrew Hall because they couldn't pay him. But there was no reason that another company without the government pays are watching them couldn't have Phibro and Hall together. It seems preposterous, but the easiest solution to solving a problem with a single employee's compensation package was to sell the entire division. So, on October 9, 2009, Occidental Petroleum purchased the Phibro unit from Citigroup for $250 million. A steal when you consider that it was reported from 1997 until the second quarter of 2009 that Phibro had an average earnings of about $200 million on a pre-tax basis, but hardly a ripoff from Citigroup's perspective since it was still better than nothing. And for Andrew Hall, it was great. Occidental wasn't under any sort of government supervision, so they could pay him everything that he'd owned and make him happy. A few years later, there was some research done on Kenneth Feinberg and all of the restrictions he tried to put on executive salaries turned into something of a scandal. Banks had negotiated special terms for a bunch of their top employees because they said otherwise they were all just going to quit. For example, the Treasury approved compensation packages for the top 23 executives at AIG that totaled more than $110 million. Or, I guess in other words, a little more than one Andrew Hall. Thanks for watching, guys.